enhancement to our overall risk management framework and supports our ability to meet our interest and dividend obligations through market cycles, like the one we are seeing today. And lastly, MSCI confirmed that digital asset treasury companies will remain eligible for inclusion in its global market indices, which we believe was the appropriate outcome. And I'll touch a little bit more about that later on in my presentation. Next slide. Next slide. Thank you. Turning to our Q4 financial results, we reported an operating loss of $17.4 billion and a net loss of $12.6 billion. These results were obviously driven by the quarter-end decline in Bitcoin's fair value under our mark-to-market accounting. Next slide. For the full year, we reported an operating loss of $5.4 billion and a net loss of $4.2 billion. We updated our target range for the full year 2025 precisely because our results are highly dependent on Bitcoin price and can move meaningfully based on market conditions. It's important to call out that our full year results were within our target guidance based on where Bitcoin price ended the year. And while accounting outcomes may fluctuate quarter to quarter, our long-term focus remains unchanged. We are committed to increasing Bitcoin per share and building durable shareholder value over the long term. Next slide. Turning to our Bitcoin KPI performance for the full year, at the start of the year, we established clear KPI targets tied to Bitcoin per share growth while recognizing a wide range of possible Bitcoin price outcomes. Under those conditions, we delivered a BTC yield of 22.8% for the year, beating the lower end of our target range, which was set at 22 to 26%. That translated into a total BTC gain of 101,873 Bitcoin and a BTC dollar gain of $8.9 billion, also beating the lower end of our target range. I think the key takeaway is that even with significant volatility in Bitcoin price, our strategy remained disciplined, and we executed against our KPIs of increasing Bitcoin per share and compounding shareholder value for the long term. Next slide. Since adopting Bitcoin as our treasury asset in 2020, we've consistently added Bitcoin per share each year. 2025 was yet another strong year in this regard, and building on the momentum of prior years and demonstrating our ability to add more Bitcoin per share in both good markets and in challenging ones as well. Our focus remains unchanged. As I mentioned before, our goal is to systematically increase Bitcoin per share over time, regardless of near-term market cycles, and continue to deliver durable BTC value for our long-term investors. Next slide. One more. Thank you. Now, turning to the balance sheet, we'll start at the top here. Our digital assets increased from $23.9 billion at the end of 2024 to $58.9 billion at the end of 2025. This was due to a $17.9 billion increase in fair value at the beginning of the year balance, as well as the fair value of the Bitcoin we added in 2025. As a result, we ended the year with also $2.3 billion in cash and cash equivalents, of which, as I mentioned earlier, $2.25 billion of that represents our USD cash reserve. As of the end of 2025, we now carry also a $1.9 billion deferred tax liability, which just reflects the accounting difference between the market value and the cost basis of our Bitcoin. I'll remind everyone this is a balance sheet item. It is not a cash tax obligation, and it does change quarter to quarter with the price of Bitcoin. Moving on. Oh, can you go back, please? In terms of long-term debt, we ended the year at $8.2 billion, which takes into account a new convertible bond as well as an equitization of a prior convert, which we executed both in early 2025. As we said before, we do not plan to issue any new convertible debt in the future, and will focus on assessing strategic liability management opportunities to the extent market conditions make sense. And over time, we intend to reduce our leverage to further enhance our credit profile. We also added $6.9 billion of preferred equity, diversifying our capital raising channels. And as a result, total equity, including both preferred and common, rose to $51.1 billion at the end of the year, up from $22.8 billion a year ago. We added $6.9 billion of preferreds through 5 distinct IPOs, as well as subsequent ATM activity. And our common equity increased to $44.2 billion through our ATM. We deployed all of that capital in an accretive manner to acquire more Bitcoin. As I mentioned before, we delivered 22.8% BTC yield, and we established the cash reserve. I'd say the year-over-year growth of our capital base strengthens our balance sheet and provides a more durable base to continue raising capital efficiently and acquiring more Bitcoin over the long term. All right, thanks, Shirish. Next slide. At the end of Q3, at the end of Q3, the market value of our Bitcoin position was approximately $73.2 billion. That was based on a Bitcoin price of about $114,000. During Q4, Bitcoin, as we all know, experienced a price decline, which drove the total unrealized fair value loss of $17.4 billion. Look, quarter-to-quarter moves like this can be sharp, can also be unsettling, but it's important to emphasize that our strategy is built for the long term. It's built to withstand short-term price volatility, even short-term extreme conditions like we're seeing today. And importantly, even in a volatile environment, we continue to execute. We purchased an additional 32,470 Bitcoin in Q4 for approximately $3.1 billion. Next slide. For the full year 2025, the market value of our Bitcoin holdings increased by approximately $17 billion from $41.8 billion at the end of 2024 to $58.9 billion at the end of 2025. And during the year, we added approximately 225,000 Bitcoin. We also recognized an unrealized fair value loss of about $5.4 billion across the year. But we significantly expanded our Bitcoin position, right? We increased our total holdings from 447,000 to 672,500 Bitcoin for the year. Next slide. Our total interest and dividend obligations are now $888 million, which is made up of about $35 million in interest on our converts. That represents an average cost of about 42 basis points. It's also made up of $713 million in dividend obligations from our cumulative preferreds, an additional $140 million related to our non-cumulative preferreds. You can see here at the bottom, our cash reserve of $2.25 billion, which was established in Q4, now provides over 2.5 years of interest and dividend coverage. And it's an important and direct benefit to our debt and credit investors. Next slide. And lastly, in October, MSCI opened a public comment period around the proposal that could have excluded companies whose digital asset holdings represented more than 50% of total assets. We felt it was important for us to be a voice on this matter, and we submitted formal written feedback to MSCI. We noted that this threshold would, in our opinion, be discriminatory towards digital assets. It's arbitrary, and in many ways, I think the proposal was unworkable, and that it rested on a mischaracterization of strategy. As a result, MSCI determined not to implement their initial proposal, and as a result, we have not been excluded from MSCI's indices. I'd note Strategy is an operating company. We have 30 plus years of history in software and tech. We have 1,500 employees. Last year, in 2025, we generated $477 million in annual revenue. And while our Bitcoin holdings has grown significantly from a balance sheet perspective, we are an operating company with a treasury balance sheet built upon a commodity. And lastly, look, on a final note, I just want to say thank you. We appreciate the strong support we receive from both active and passive retail and institutional investors, regulators, and policymakers, all in support of our efforts on index inclusion. We thank you for that. I think there's still some more work to be done, and we look forward to working with the industry in the coming year on that as well. So with that, I will turn over to Phong, our CEO. Thank you.
Thanks, Andrew. I first just want to acknowledge, I understand the market conditions for today's call is challenging.
We're dying, baby. Pump
and the
us.
fact that we have thousands of people watching this is a testament to your intellect, your curiosity, and for many of you, your conviction. So thanks everyone for joining us today. I also want to share, look, some of you bought Bitcoin or MSTR in the last year. This is your first downturn. My advice is to hold on. Remember the fundamentals that cause you to buy Bitcoin. It's because Bitcoin is the digital transformation of capital, or maybe it's because it's the hardest and most ethical form of money, or because you believe in a non-sovereign, censor-resistant store of value. None of these fundamentals have changed. They didn't change in the last year. They haven't changed in the last 18 years. For the MicroStrategy shareholders and the strategy shareholders now, remember the fundamentals of why you bought into MSTR Common. Because we are levered and amplified Bitcoin. We're built to outperform Bitcoin over the long run. It could be because you see us as digital innovators. We invented the enterprise business intelligence software space in the 1990s, and we invented digital treasury companies in 2020. Or it's because you believe in the management team that's here today. None of that's changed in the last year. And for those of you who have been with us on this journey since 2020, you've seen other periods of Bitcoin and MSTR downturns, and you held on, and you were rewarded for your conviction, so thank you. And perhaps I ask that you share your wisdom and your confidence with those who are newer to the community. X is a great place to do this. In person is a great place to do this. And a great opportunity to get together in person. Next slide, please. Is Bitcoin for Corporations. We will have our 6th annual Bitcoin for Corporations in Las Vegas in 3 weeks, February 23rd through 26th. I'd love to see you there. It's a great place to get together and learn about Bitcoin, Bitcoin treasury companies, digital credit, digital capital, and digital money. It's also a great place to see our software business in action. And as Andrew mentioned, our software business constitutes 1,500 employees and over 3,000 customers. And they'll be there showcasing the transformation of intelligence and the intersection of AI and BI. And I would like to note we had a great year last year in our software business. We saw a big cloud transition as our revenue went from decline to increase at 3%. And our cloud revenue went up 65% year over year. So I invite you all to join us in Las Vegas, February 23rd through 26th. Next slide. Take a step back. This is our business. We have been buying and holding Bitcoin since the 3rd quarter of 2020. Every single quarter, we now have 713,502 Bitcoin with a total acquisition cost of $54 billion and a $76,000 average Bitcoin purchase price. Recognizing now that Bitcoin's below the average Bitcoin price, you might ask the question, what does that mean? It really doesn't mean anything, right? It doesn't mean that we have any issues servicing our debt or paying the dividends on our preferreds. We don't have any covenants or triggers that say when Bitcoin price goes below our average Bitcoin purchase price, that anything has to occur other than we continue with our strategy. Next slide. 2025, as Andrew mentioned, was a pretty big year for us in the capital markets. As you see here in 2024, we raised $22.6 billion, and we actually outstripped that number in 2025. The big change last year was we moved from convertible debt $6.2 billion in 24 and $2 billion in 25 to $7 billion of preferred. We invented digital credit, and we invented the preferred market, which now other Bitcoin treasury companies are moving into, issuing perpetual preferreds. We're pretty excited about this. You'll see here we had 5 IPOs. The other thing I'll note here is that year to date 2026, in the face of a tougher Bitcoin market, we were able to, in 1 month, raise an additional $3.9 billion of capital. And for the most part, buy Bitcoin with that. Next slide. So what do those big numbers mean? How do you think about that? In 2024, we were the largest US issuer of equity in the entire country. Last year, 2025, we were once again the largest issuer of equity. We were 8% of the entire equity capital markets, 6% to the common equity market, and 33% of the preferred equity market. We are getting people to invest in our company through equity raises and preferred raises, and turn that into Bitcoin, Bitcoin per share, and Bitcoin yield to our shareholders. And we're doing it with the intersection of traditional finance with some of the largest banking partners in the world. Morgan Stanley, Barclays, Moelis, TD, Benchmark, Clearstreet have all been participants in these markets, and they give us distribution out to wealth management and to retail and to institutions. So we've been very successful in the last year with continuing our strategy. Next slide. You'll see here, in addition to getting folks to participate in our equity raises in our equity capital markets, we continue to add more and more research analysts. Here you can see price targets, and you can see they all have buy ratings on strategy. Next slide. So let me talk about digital credit and what are we doing in digital credit and why digital credit is important. Next slide. First, I mentioned 2025 marked the launch of digital credit, and we launched 5 different instruments. We started with Strike, which is convertible digital credit, and it was really a gateway from convertible debt, which we no longer are issuing, to a convertible preferred note. We then launched Strife, which was our most senior of our instruments, our first fixed perpetual digital credit instrument, and after that we launched our most junior one, Stride. And as you can see, the size gets bigger and bigger with each one. And then we launched the most important, which was Stretch, which is $2.5 billion in our first digital credit instrument. And then in November, we went to the Euro market and launched Stream, which is $717 million in US dollars. And the importance of this is accessing a European market and those who want Euro exposure. Our plan with Stream is to, over time, uplist it into a regulated retail accessible market. And we're excited to do that over the course of this year. Next slide. Here's the overview of digital credit. I think the most notable here is to look at, as an example, the liquidity that we're experiencing in Stretch. $118 million traded a day over the last 30 days. As a comparison, typical US-based prefers trade $1 million a day. So these are very liquid and very interesting instruments. The dividend at 11.25% and on a tax equivalent basis, 18%. And you also see the volatility here at 7%. So it's an instrument where we've been able to start to target a very finite price close to $100 and drive that volatility down to 7%. Let's go to the next slide. So what is 2025, the third quarter, and the rest of 2026 been about? It's really been about seasoning our digital credit. And by seasoning, I mean maturing the market and making the instrument more creditworthy. So after we launched Stretch in July 25, there were a couple actions we took that made the credit more creditworthy and a better investment. First, and Andrew mentioned it,
Oscar
the
went all
CAMT
in on
guidance was a
Trump
big
going, my
deal.
wife took the
This was a
kids.
big change by Treasury and IRS, acknowledging the importance of the digital asset ecosystem and that there should be no unrealized capital gains taxes on Bitcoin, period. The second thing is we got an S&P rating, a B- issuer credit rating, which was a starting point for us to be able to access different types of investors in the credit market. November 4th, we got to what really was our target, was to get Stretch to trade at par, $100 for the first time. $100 is important because it decreases the volatility of the instrument. It shows that we're able to do something that no other preferred instrument has done in its past, which is to target a specific price, and it allows us to raise more via our ATM. And then we added our US dollar reserve. At the same time, since we launched Stretch, we have added 105,732 Bitcoin to our balance sheet. That's about 16% more. These are all actions we took to make our digital credit stronger over time. Next slide. So what is Stretch, right? Why are we so enamored and excited about Stretch? Why did I say 2026 is the coming out party for Stretch? Stretch is one of the most attractive instruments and securities in the market today. It pays an 11% effective yield, 18% on a tax equivalent basis. We've paid monthly dividends on time, on schedule. And we have said that we expect the return of capital treatment for the next 10 years. We'll run our business to be able to give everybody tax deferred earnings for the next 10 years. We're targeting a $100 price. The volatility is 7%. It's actually decreased recently to 6%. And we have mechanisms above and below that price to keep the price stable. It's quite a bit of feat of financial engineering. And it's extremely over collateralized. After you take out all instruments that are senior to Stretch, we still have 5.6x collateral over Stretch. And so it's an over collateralized instrument. And then after that, we've added $2.25 billion of US dollar reserves. So we have 2 to 3 years of dividend coverage. And I'd mentioned the liquidity of Stretch is trading extremely well. It's NASDAQ listed. It has a 4-letter ticker. It's easily accessible to folks. It's now accessible on Robinhood and Square Cash App and pretty much anywhere else that you can buy a security. Next slide. So let's talk about our balance sheet. I've seen a lot of questions. We get them from investors. We get them from shareholders. We get them from people on X. What's going on with Strategy's balance sheet? Are you worried that when Bitcoin price drops that you are going to have issues with your convertible bonds? Are you going to have issues paying your dividends? Are you going to have to sell Bitcoin? The short answer is I'm not worried. We're not worried. And no, we're not having issues.
We're not worried,
what's
fam.
The reason? One, we have a BTC reserve that's $60 billion. This was as of last Friday.
We got some billions.
$5 billion.
Don't worry.
Our equity, our enterprise value still trades above our Bitcoin reserve. Our convertible debt, that's the notes that come due, or preferred equity doesn't come due, is at about 10% leverage. For the latest Bitcoin price as of today, we still have about 13% leverage. So the $8.2 billion that come due is 13% leverage. How do you think about 13% leverage? You know, those who do not spend a lot of time in the debt world, you might say, wow, 13% sounds like a lot. Let me show you how we compare 13% to the S&P 500 universe. Next slide. First thing is when you take your leverage, you take out the cash that we have. So our net debt is $6 billion. As I mentioned, our net leverage is 10% and it's 13% with the most recent Bitcoin price. If you look on the bottom left-hand side, this is how we compare to the S&P 500 universe, right? We have 10%, currently 13% leverage. If you're a AAA rated, right, investment grade company, your bonds are trading as AAA rated, you have 23% leverage. If you're BBB rated high yield, you have 32% leverage. We have half the leverage of an investment grade company, a third of the leverage of a high yield company. How about looking at it by sector? Strategy at 13% looks like a tech company, which is low capital, low assets, you know, high income, right? They're levered at about 15.7%. You know, compare us to asset heavy, you know, high debt companies and industries, utilities or real estate, they're levered at 42 to 48%. We are not a highly levered company. Next slide. What about our convertible debt, right? Not very highly levered, so that's good. But what happens when our convertible debt comes due over the next 5 or 6 years? Are we worried that we're not going to be able to pay back our convertibles? No, not really. You see here the net debt of $6 billion compared to a Bitcoin reserve of $59 billion, now $45 billion. In the extreme downside, if we were to have a 90% decline in Bitcoin price and the price was $8,000, right, which I still think is pretty hard to imagine, that is the point at which our Bitcoin reserve equals our net debt, and we will not be able to then pay off of our convertibles using our Bitcoin reserve, and we'd either look at restructuring, issuing additional equity, issuing an additional debt. And let me remind you, this is over the course of the next 5 years, right? So I'm not really worried at this point in time, even with Bitcoin drops, that we're not going to be able to service our convertible debt. All that said, it's staggered over time. We have put dates between 2027 and 2032, and our plan is to equitize that over time. And if we're not able to equitize it, we'll find different ways to restructure the debt. Next slide. Of course, we have this Bitcoin reserve, and what does it really do for us? It creates long-term durability. That's why we've been building it up. That's why we've added about 16% over the last 9 months to our Bitcoin reserve. It gives us long-term durability to issue more credit, ultimately. And as we issue more credit, the dividends will rise. Our dividends, as Andrew explained, $888 million. We have 67 years of dividend coverage with our Bitcoin reserve. If Bitcoin goes up 1.5% a year, that's our break-even ARR, we could just sell the incremental Bitcoin that we get, not that that's what we'll do, to pay our dividends. So we don't need a large increase in Bitcoin price to be able to service our dividends primarily through Stretch. Next slide. Our US dollar reserve, which I'm very happy we put in place in Q4 and solidified in Q1, is $2.25 billion. That's 30 months of dividend coverage, 2.5 years of dividend coverage. So if we were not able to raise capital, which we've shown that we've been able to do through equity issuances, we could sit here, do nothing, and pay off our dividends over the or satisfy our dividends over 30 months using this reserve. Next slide. And as I mentioned, since we received a B- stable outlook credit rating from S&P, we've taken a lot of positive actions to improve this. Right? Well, will the S&P increase it from B-? I think if they were to make an evaluation today, they likely would, but they usually make evaluations every year or so. They don't want to move fast in terms of what the credit rating is, but we've added a US dollar reserve, $2.25 billion. I'll remind you that the first $1.44 billion we raised in 8 days. The second is we've been able to maintain a robust access to capital. We raised $9.5 billion in 3 months and 72,300 Bitcoin. So we've shown that we're highly liquid and able to access capital. And we paid dividends every single month, every single quarter since our credit rating. Next slide. So what are we going to do to make Stretch even better? In addition to improving the credit quality, we've been working with brokerages like Robinhood and Cash App to get.
This is what an earnings call looks like, fam. Just happens to be one of the biggest crypto/Bitcoin companies, right? MSTR, MicroStrategy. Picture this. Ripple becomes public, opens up. That's what we're going to be doing, everybody, religiously, because we love XRP, right? So they're not doing it because they're not public, right? They're private. They're public, so they have to do that. And we're waiting for Michael Saylor, right? I mean, what is he going to say? Right now, all the executives are speaking, and Michael Saylor should be coming after this. Welcome, fam.
So, all right, we've been involved in industry conference, leverage finance conferences, teaching sessions, and so we're telling everybody about Stretch. And we engaged in digital marketing. You might have seen ads on X or YouTube or Wall Street Journal. And of course, we have strategy.com, strategy app, interviews, and podcasts. We want everyone to be aware of digital credit because we think it's an amazing product for an end investor. And we think it helps build the strategy flywheel and the Bitcoin flywheel over time. Next slide. I do want to update a slight change to our Stretch guidance. In the past, we've said that we're going to base our actions on Stretch on a 5-day VWAP at the end of the month. What we found is that Stretch trades very interestingly around dates like our record date and our payment date. Our record date falls before the 5 days at the end of the month, and that's where we've seen people try to buy stretch so they get in before the record date. So we thought the better view of stretch price is to look over the course of the entire month. So the VWAP range by which we'll look at the price of stretch and make determinations on what to do with our rate will be based on the entire month. So as an example, for January, if we were to have made that change in January, it would have been January 1st through January 31st. For February, it'll be February 1st through February 28th. Next slide. So we talked about digital credit, and the importance of digital credit is what it does for a digital equity. Digital credit amplifies our common equity. And I just looked at these numbers were as of last Friday. As of today, MSTR is up 48% since we started this strategy. Bitcoin's up 36% since we started this strategy, and we've outperformed the Mag 7 Gold S&P 500. We're amplified Bitcoin designed to outperform Bitcoin, and our belief is Bitcoin will outperform every other asset class in the world over time. Next slide. How do we create amplified Bitcoin? How do we outperform Bitcoin? We produce Bitcoin per share. We increase Bitcoin per share, which is the change in Bitcoin per share is Bitcoin yield. And you look here over the course of the last 6 years, we've increased Bitcoin per share every single year. That's why we outperform Bitcoin. If you buy 1 Bitcoin at the beginning of the year, you'll have 1 Bitcoin at the end of the year. If you buy 1 share of strategy at the beginning of the year, 2025, you would have had 23% more Bitcoin at the end of the year, 2025. We increase Bitcoin per share, and we call that increased Bitcoin yield. Next slide. So how do we think about this over the course of the next 7 years? I showed you what we've done in the last 6 years. The way we're going to increase Bitcoin per share over the course of the next 7 years is we are going to sell digital credit. And what does digital credit do? By selling digital credit, we generate amplification. By generating amplification, we increase Bitcoin per share. By increasing Bitcoin per share, MSTR common outperforms Bitcoin. It's a very simple formula. And what are the inputs? How much digital credit can we sell? Which is how much stretch can we sell? Here's an assumption that on a base of $60 billion of Bitcoin, if we can sell 10% of digital credit, which is $6 billion, this is what this might look like over time. And you say $6 billion, is that a lot or is that a little? Well, last year we sold $7 billion of digital credit, and we raised over $25 billion in the equity capital markets. So we think this is a fairly conservative assumption, $6 billion. This assumes a 10% dividend rate, which is where we are right now, and that we're issuing equity to pay for the dividend on digital credit at 1.34x MNAV, right? And so I'll call this a low scenario. If we have this low scenario over the course of 7 years, we'll increase Bitcoin per share 1.4x. That's a 5% annual Bitcoin yield. Next slide. What if we can do a little bit better? What if we can assume 16% of digital credit sales? So not $6 billion, but $10 billion. What if the Fed lowers interest rates, or we're able to lower interest rates on our digital credit down to 9%? And what if the view of this causes investors to believe we'll increase Bitcoin per share and our MNAV goes up and we have amplified Bitcoin and MSTR, and we're able to get to 1.75x MNAV? This scenario with a assumption of 30% Bitcoin ARR gets us to a 2x increase in Bitcoin per share over 7 years, which is a 10% annual BTC yield. Next slide. What does a more aggressive scenario look like? Maybe we can assume 20% digital credit sales. We're able to drive the dividend rate down to 8%, and our MNAV goes up to 225. Then we can increase Bitcoin per share 2.5 times over 7 years and a 14% annual Bitcoin yield. That's another scenario. And I'll go to the final slide of my section. Ultimately, this is the strategy of the company. We're going to issue digital credit through stretch. We're going to amplify the common equity because of it. It increases our Bitcoin per share, and we outperform Bitcoin. What are the levers that we can play with? How much digital credit can we sell? How attractive can we make Stretch? How well do we market it? How well do we distribute it? With higher demand, we can lower the cost of credit and we'll increase the MNAV. That's the thesis for the company, and that's what we're excited to do, and that's what we're going to focus on in 2026. So with that, I will pass it over to Michael.
Finally.
I'm delighted to have you join us today. Why don't we go to the next slide? All of our strategy is based upon looking at the fundamentals and taking a 10-year view. And so when you consider the fundamentals of digital capital, you have to start with the most important regulator in the entire world, and that is the President of the United States. We have a Bitcoin president, and he's intent upon making America the Bitcoin superpower, the crypto capital of the world, and the leader in digital assets. I don't think you can underestimate the importance of having support for the industry and digital capital at the very top of the political structure. Now, equally important, if we look at the cabinet that's been put in place on the next slide, you see the entire government is now embraced Bitcoin. And when I say embrace Bitcoin, what I mean is 18 months ago, there was one person in the government that had an awareness of it and was skeptical to neutral or grudgingly accepting of it. And everyone else in government was either negatively inclined or they were ignorant of it. And now there are 12 individuals I'd want to highlight here. J.D. Vance, the vice president, Scott Bessent, the Treasury Secretary, Paul Atkins, the head of the SEC. Number 4, Kevin Warsh, who is the Fed chair nominee, who understands digital assets, understands the use case of Bitcoin. This is a tremendous move forward for us, a big fundamental shift that now you can look at the head of the SEC, the head of the Treasury, and the head of the Fed as all appreciating the pivotal role of digital assets in the growth of the country and the economy. And if you go to the second line, right, you see the head of intelligence, the head of the Small Business Administration, the head of federal housing, the head of health and human services, all Bitcoin believers. And then Michael Selig, the CFTC chairman, David Sachs, who's doing a wonderful job, Howard Lutnick, Commerce Secretary, and even Kash Patel. So if you consider that, we went from one neutral to a Bitcoin president and 12 positive constructive. This is great fundamentals for us, and I don't think we can lose sight of this because everything that follows in the marketplace is very much influenced by the political structure of the world. On the next slide. Capitol Hill has embraced Bitcoin. We've got bipartisan consensus that the United States should embrace digital assets, should embrace digital capital, should be a leader. That is not a debate. No one's saying that there's one party in favor of digital capital, another party against it. That's a big deal. So although the political process is complicated, the fact that we have moved from an asset which was a scary speculative thing and maybe illegitimate to a legitimate asset that most reasoned politicians and regulators and policymakers believe they need to move constructively forward with. Let's go to the next slide. Big banks are embracing Bitcoin. Roll the clock back 18 months, and this Harvey ball diagram is pretty much blank, mostly blank. And so when you actually look at the top financial institutions and you ask the question, do they allow IBIT trading? Well, there's an avalanche of support there. That's flipped in 12 months. The second question is, do they offer credit against IBIT? That's a big deal. 12 months ago was almost impossible to get a loan or a margin loan against IBIT. Now there are many banks coming into space. Would they let you trade BTC? Now you have banks that are announcing support for that. You have banks announcing support to custody BTC, and you have banks announcing intent to offer credit against BTC. Again, This is an extraordinary sea change. We cannot underestimate the value. I think that the fundamentals of the industry are driven by the banks creating credit. One bank can create as much credit as all the Bitcoin miners can create in Bitcoin in a year. So each bank that turns on Bitcoin-backed credit lines might be the equivalent of another halving for the network. Let's go to the next slide. TradFi and FinTech have embraced Bitcoin. If you look at the number of accounts with BTC trading asset, there's a pretty clear bullish trend here, both across crypto native exchanges, fintechs and neobanks, and the brokerages and banks and the wealth management channel. Those are large numbers. Fundamentally, we're going from an asset class that no one could buy if they wanted to an asset class where everyone is competing to facilitate access and exposure. The next slide. This is the ETF trend. ETFs are embracing Bitcoin. 125 ETFs or ETPs launched. 1.4 million Bitcoin held in them. A very consistent trend up and to the right. Next. And this is the corporate trend. It was nothing in 2019. We were the first serious player. We were lonely for a bit, then we went to 33, then we were 64 in 2024, and now we're 194. This is clearly explosive growth, and there's a signal here. Next. The public markets are embracing Bitcoin. Look at these IPOs that have taken place this year: Bullish, Circle, Gemini, BitGo, Kraken, that's coming. And then Coinbase, Block, and Robinhood have all been included in the S&P 500. So I see this as a very bullish indicator and a fundamental improvement in the structure of the industry. The concern du jour is quantum computers, and many people ask, do quantum computers represent a threat to Bitcoin? I would note that the quantum computing concern and quantum FUD is just the latest in a long litany and a parade of horrible FUD that has been taking place since the beginning of Bitcoin. There was functionality FUD. Bitcoin's not functional enough, so it will fail. It needs smart contracts. And then people thought it was a Ponzi, and then they thought it was too volatile, and then they thought, well, there was a bug in it, and maybe it'll be 51% attacked. Maybe the Chinese control too much of it, and then there was the Chinese shut it down. It was the opposite of the China FUD. It was the China non embrace. And then we had all manner of block size wars and bandwidth FUD, and then there was a uses electricity FUD, and then there was the wealth concentration FUD, and of course then there was another crypto will be better. What I would say is whenever dealing with each of these concerns, we have to take them seriously. We have to consider them, but we have to remember two things. One, the two words on the back of the Hitchhiker's Guide to the Galaxy: don't panic. Most important two words, more important than everything in the encyclopedia or the Hitchhiker's Guide to the Galaxy. The second observation, the Hippocratic Oath: do no harm. And so whenever you're faced with a challenge in any system or any network, you have to make sure you don't panic. You're not railroaded into doing something foolish or destructive. And you also can't do something that causes harm. You don't want an iatrogenic intervention where the cure is worse than the disease. So our position on quantum computing: one, we think it's probably 10 or more years away before there's a threat. That is the consensus. It's a promising technology, but it's still nascent. Many industries, including finance and defense, are dependent upon traditional cryptography. They face the same risks. There's a significant global investment going into building quantum-resistant protocols, not just in the Bitcoin community, across all communities. The Bitcoin community in specific is engaged on research and development in these efforts. There's good work that's taking place. If Bitcoin requires an upgrade, there will be global consensus. Right now, there isn't global consensus that existing cryptographic libraries are at risk. And to stampede into a hypothetical fix before there is consensus would introduce new attack surfaces and new complexity and new failure modes that don't currently exist. It's very similar to over vaccinating. When it's like, well, there's a 0.001% chance that the kid might get a disease. So we're going to vaccinate them just in case. But of course, 3% of the people that get the vaccine have side effects, right? And so it's very important that we don't over-insure, over-vaccinate, over-treat, over-worry. It's a famous president of the United States. He said, if you see 10 problems driving down the road, 9 of them will probably drive themselves into a ditch before they get to you. So the one thing you can't do is you can't buy 100 expensive insurance policies that cost collectively 100% of all your operating income to insure against something which is 2% likely to happen. That's why you have to be very thoughtful about addressing these risks, and you have to address them at the right time, not too soon, not too late, but because too soon, you probably don't have the right technology and you're over-insuring. Too late, right? You accept the risk that you shouldn't. That's why consensus is very important. Bitcoin will be stronger if and when that quantum upgrade takes place, right? And so Bitcoin is upgradable, and Bitcoin can be upgraded to be stronger. And we, of course, are optimists, and we believe that the human race will accept challenges and will upgrade to meet those challenges and do it in a rational fashion. And Bitcoin has a history of meeting challenges in a rational fashion such that it is stronger. And you can see all those examples. Last, but probably most important on this slide, strategy, we are going to initiate a Bitcoin security program that coordinates with the global cybersecurity community, the global crypto security community, and the global Bitcoin security committee in order to help and contribute to consensus and solutions to address the quantum computing threat, as well as any other emergent security threats that evolve. We think it's reasonable and appropriate for us to do this, given our large responsibility as a Bitcoin holder, but we want to do it in a very responsible fashion, and we want to make sure that we coordinate with the global cyber, crypto, and Bitcoin security community, because there are a lot of very, very brilliant minds here. There's a lot of good work being done, and it's likely that consensus will form and solutions will form at the right time in a responsible fashion. So that's our view on quantum. Next slide. Digital credit. Our company exists we structure and we secure Bitcoin, right? We're a digital credit issuer. If you look at this chart, what you can see is that the native volatility, or the natural volatility of Bitcoin, is about 45. For a 45 vol asset to draw down 45% shouldn't shock anybody, right? And I note that Bitcoin looks like it's drawn down about 45% since its all-time high 4 months ago. So a 45% drawdown on a 45 vol asset is probably to be expected, just like an 80% drawdown when it was an 80 vol asset. On the other hand, what you can see pretty clearly is that strategy has stripped that volatility off of BTC with Strike, which was 32%, Stride 27%, Strife 24%, and Stretch down to 7%. So we are stripping the volatility off of Bitcoin, and there is conservation of energy and conservation of volatility. And so the volatility that we strip off of the credit instruments accrues to the common equity. And so that's why MSTR is 63 vol. But it's not really a complicated piece of engineering. It is just It is very pure financial engineering. There's a group of people that want low vol, principal protected instruments that are credit instruments, and there are other people that want high vol, high performance. Next slide. Right, think of us as a digital credit vehicle. Our job, we are thrusting forward. We are actually moving through space, through issuing digital credit. Right, it's digital credit is the product. Bitcoin is the backing collateral. The secret, or the most important thing for us to do, is to build the vehicle in the most robust, fault tolerant way that we can, the most scalable way we can. You could think of it as a Bitcoin battery and then a US dollar battery. And we have lots of options. We have options to run on the US dollar reserve. We have the option to sell equity. We have the option to sell Bitcoin. We have the option to sell Bitcoin derivatives. And we keep our options open so that we can do the best thing for all of our stakeholders. Our common stock shareholders, we want to do the right thing for the MSTR common stock shareholders. We want to do the right thing for the credit holders of the digital credit instruments. And we want to do the right thing for the Bitcoin community. And we believe that if we're rational and thoughtful, then we get a good outcome, which is BTC positive, MSTR positive, STRC positive. Next slide. Companies exist to convert capital into cash flows. In essence, you have capital investors and you have credit investors. The credit investor wants $10,000 a month forever. And the capital investor gets $1 million of real estate with no cash flows for the next 30 years. And maybe they'll get more than 10% a year. Maybe they'll get 20, 30% a year performance. But it's pretty straightforward that the world's built on capital. The world runs on credit. BTC is digital capital. STRC is digital credit. It takes an operating company to transform capital into credit. If we were a real estate development company, we could take $50 billion of capital, buy a bunch of land in New York City, build a bunch of buildings, market the buildings, rent the buildings, and generate the cash flows. That's a way to do this. But you take on all sorts of liability, all sorts of counterparty risk, operating risk. It takes a lot of time. You have property taxes, employment taxes, income taxes, usage taxes, etc. That's the 20th century way to actually create credit from capital. We've taken a much faster route. We would just take the money, buy Bitcoin, and just issue the credit, and we skip all the intermediate steps. That makes us extremely technically efficient. It makes us extremely economically efficient. It makes us extremely tax efficient. Next slide. At the core, what are we doing, right? We're transforming that capital into credit. We're taking BTC and we're converting it into a currency, whether it's a US dollar or a euro. We're stripping the risk by over collateralizing it, right? If you have $5 of Bitcoin, right, and it falls by 80%, then you've got $1 of Bitcoin. But when you have $1 of STRC backed by $5 of Bitcoin and it falls by 80%, you've still got $1 of STRC backed by $1 of Bitcoin. So we're stripping or reducing the risk by the BTC rating. And then we're also taking other actions to reduce risk, right? We're an operating company. We can raise capital. We can sell equity. We can refinance. We can strip risk by taking a 2-year obligation or a 10-year obligation and stretching it out to a 20-year obligation. So operating companies can do these things. We're also damping the volatility. We damp the volatility by building the collateral, by building the US dollar value, by adjusting the dividends, by adjusting the ATM programs, by adjusting our capital markets behavior. And we adjust these things minutely every minute, maybe even every second, right? We have programs to adjust all of our activities so as to damp volatility. And we're very engaged and we're very focused on it. Of course, and then we distill the yield from the capital asset in order to create a fixed income yield rate. And of course, we're compressing the duration. Instead of telling you to wait 10 years in order to get a 30% return, we're giving the 18-year-old cash flow this month and every month. So 10 years of duration is 120 months. We're converting 120 months into 1 month duration. And so when people say, what does the company do? The company transforms digital capital into digital credit. Are these things valuable? Of course they're valuable. There's a $300 trillion market for credit. It's extraordinarily valuable. And the key is for us to create the best credit in the world and to create the best credit you can using digital capital. Let's go to the next slide. How do we benchmark ourselves against the other credit alternatives? Well, the bank accounts might give you 40 basis points. The money markets are giving you 360 basis points. Taxable. Insurance companies don't pay tax and endowments don't pay tax, but actual real people, families do, private companies do, public companies pay tax. The world's full of people that have to pay tax. And so 360 basis points of money markets, works out to might be only 180 basis points if you live in New York or California after tax. So clearly what we have here is a yield-starved environment. The base rate and the risk-free rate is 360 basis points taxable. And that means that all the conventional credit instruments are pegged to that, like mortgage-backed securities, investment-grade bonds, junk bonds. They all trade at very small premiums or spreads over that risk-free rate. And STRC is paying 11.3% at par, 11.25% at par. And so you can see here that it's 3 times more on a pre-tax basis, but on a tax equivalent basis, it's like a bank account in Miami that pays you 18%. It would be much more. It'd be like a bank account that pays you 22 or 23% in New York City or San Francisco. So we think we've been able to create a very compelling credit instrument versus other credit instruments. It's just 2 to 4 times better. And let's go to the next slide. We don't just benchmark ourselves against other credit instruments. We also benchmark ourselves against all the other non-US dollar currencies. And what you can see here is the US dollar has got a 370 basis point risk-free rate, but the Korean won, the Canadian currency, the euro, Singapore dollars, Japanese yen, Swiss francs, they're much weaker. And so fundamentally, you could think of the stretch rate as the risk-free rate in the Bitcoin ecosystem. It's like the Bitcoin rate, short end of the yield curve. So we are working to define the yield curve. Like if you're willing to accept no guarantee of yield and 10-year duration, then you get the Bitcoin rate, which is, right now 35-40%. We expect Bitcoin will be 30% over time. But if you want to go to the short end of the yield curve to the 1 month end, then 11.3%, right, is the rate. We think that this creates just a very compelling opportunity. Clearly.
Okay. Yeah, now that's it. I can go on and on, but no, that's it. Okay. Sum up. He's not selling. He's telling all of his shareholders and stakeholders it's all fine. And huddle, because we're going to the moon. We're going to the moon. And we pump it up. What's up, fam? Welcome. All right. Got a few things to do, but I wanted to do this because Q&A is going to happen, but I don't have any time right now. We've been here for a while, so it's been so fun. I'm asking you here, all in one, and you're 68% XRP. That is my fam, exactly. That's what I'm talking about, brother. Let's go. Well, the lowest for XRP so far that we got over the last couple of minutes, it's been 1.13, 1.13 per XRP just a couple minutes ago, guys. Just literally a couple minutes ago. So the price started climbing over the last couple of minutes, so it's really nice. Look at this. Some volume is coming in right now. That is 1.13 XRP at 226. What time is it right now? It's 5. So 2 hours or plus. 2 hours and 41 minutes. So less than 3 hours, and the price of XRP, we're seeing it growing. Look at that beauty. Look at that beauty. Look at that beauty right there. Don't you know? Pump it up. You got to pump it up. That's good. That's good. Guys, we're not selling anything. I'm not selling anything at a panic level. Never. You know why? You want me to tell you why I'm not selling anything right now? I'll tell you why I'm not selling anything right now. Let me show you our daddy here. Let's go. Brad Garlinghouse says, Warren Buffett quote, be fearful when others are greedy and be greedy when others are fearful, everybody. And I was like, breakout confirmed, XRP all in. Why not? Why not? So we're feeling good. Obviously, it's painful. Obviously, nobody wants to see XRP collapse. I don't want to see XRP collapse, but how many people were freaking asking me, hey, when should I buy XRP? Today. Today. So, am I really selling XRP at $3? I don't want to because I know how much higher we can go. That's why I didn't sell when it was at 360. I didn't sell XRP at 360, so it makes me look like a fool. By some people's standards, I'm a fool. That's okay. I don't need the money right now. That's okay. Some people sold. That's okay. Take your money. Great. But I just didn't know how aggressive Trump was going to be. And right now, even stocks are down. Everything's down, which is okay, right? Be greedy when others are fearful. That's why I'm playing the long game, fam. I'm playing the long game. I think we're going to be fine. Really, really fine. Woo! Okay, everybody. I gotta work on something right now for a client. We still have some people coming in and reaching out. We're really happy and blessed. But yeah. Oh, baby. As soon as you come into CT, there's all kinds of things coming in. We are here, not here. Everybody, a major ballistic, biblical, and universal super cycle is in the works right now. The super cycle that nobody has ever seen before is in the works right now. I believe it. I know it. Everything points in that direction. Everything points in that direction, and that's why we're going to be okay despite what we're seeing today. That's all I got to tell you today. Okay? My fam, I love you guys. Honestly, it baffles me how we still have a lot of people here. Look at the level we are right now. JB, TJ, Chipper. Look at the level that we have right now. We're collapsing, and the OG people are here with us. We're the best community in the world. We got the best community. We're the best people here. And that is why I tell BTCC, and I'm pushing them, we got to give them more money. We always got to give them more money. And you know why? I'm going to ask them, what if we give 4,000 XRP this time? For the first time ever, 4,000. So, yeah, that sounds like a plan. Instead of 3,000, why don't we go ahead and give 4,000 XRP? Giving you guys more chances to win and giving you guys more XRP to win. Why not? All you got to do, guys, first link down below, we Got brand new links for everything. So enjoy, have fun. Links down below. Check them out. They look really good. With that being said, have a good one. God bless you all. Please be safe. Please don't do anything stupid. Your life is more precious. Don't worry about money much. Your life is worth more than XRP. Your family loves you. You are valuable. So don't worry. Might be a little stressful, but that's why we go live. Because I know people need this a few times. Okay? Just relax. Leverage my house right now. I love the people, man. Crazy. Have a good one, everybody. You take care. Peace. Oh, baby. I love this. Get alone. Buy more. Just enjoy this, guys. Just enjoy little by little by little. Nice. Awesome. Todd, I'll add you right now, brother. You know, TJ, I'm going to add my LinkedIn because I have a bunch of links. I didn't add my LinkedIn. I'm going to add my LinkedIn so you guys can tell all my experience. Yeah. Doesn't really make much. Why not? I'll add it so people can add me because there's a lot of professionals here too that have LinkedIn accounts. Why not? And I like it. Back in the day, 10 years ago, I remember everybody was LinkedIn. Oh, yeah, have LinkedIn. You guys remember that? I mean, it's crazy. Now it's like, whatever. Who cares? Peace.